Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
This is another important one, equivalent labor productivity. Part of the reason the euro was created was this idea that you would have a lot of labor mobility. And even going into this process, everybody knew that Germany had the highest labor productivity rates across the zone. But the pipe dream was that once all the borders would be open and everybody was, free to trade with one currency, and they took away the passport requirements and things, that you'd see people move from country to country, and you'd see an equalization of productivity across the countries. Well, that really hasn't happened. And Germany has maintained its productivity, and countries like Italy and Greece have continued to lose productivity in a very, very big way. Now, the problem that creates is when you have that type of thing happening, usually the currency is the pressure valve, meaning your currency devalues in order to equalize your fall in labor productivity. Well, we have one currency here, and the other countries have not been able to devalue because they're all stuck to the euro. And what you're seeing happening now that things are on the downswing, these countries facing major tensions on the fiscal side in order to really generate what would be equilibrium on this side of the fence. They're going to have to cut wages in a very, very big way, drastically, and that's the concern now shaping up in Spain, and it's been a problem in Greece and a big problem in Italy too. So this is a real problem. There really is no external pressure valve that a floating currency would normally provide. They're locked into the euro. So all of the differences in labor productivity have to start being taken domestically. And now that we have these fiscal problems getting worse and worse, this pressure is building and coming to the fore. It wasn't a problem again. Things were papered over during the upswing. Why was the euro really created? It was really created to develop a captive market for German exports. One currency. Germany was basically subsidizing the system, allowing the other countries to borrow at German interest rates in order to pump up domestic demand across the Eurozone, inside and outside the Eurozone, but primarily inside the Eurozone, which created, as I said, a captive market for German exports. It gave them a significant competitive advantage, everybody trading in euros. So that was part of it. Again, the southern tier countries, the pigs, there's no way they should have been able to borrow at German rates, but Germany's incentive to be the core of this system was to create liquidity for those countries to drive demand for its exports. The other reason was to support the Eurozone banks, and I'll show you this number, and you'll be surprised in a later slide. The Eurozone banking system makes up an inordinate amount of the GDP, and their assets relative to GDP are humongous compared to the assets relative to GDP in the U.S. financial system. So again, the euro was created really to increase the profitability of the banks. Not only could they reduce their administrative costs using one currency, but they could do a lot of this lending in order to drive these captive German exports, and all the sovereign credit that they created for those southern tier countries to create demand for German exports. And as I just said, the southern tier countries to borrow at lower rates. It's all part of this process of really why the euro was created, despite all the lofty designs of competitiveness and this and that. And it's worked very, very well in the upswing, but the game is changing because this incentive system is starting to break down, and the fact that the exposure now is so great because the Eurozone banks really were just out of control on their lending. So their exposure to these pig countries that don't look like they're going to be able to pay back most of this stuff they borrowed, it has soared tremendously, and I'll show you the numbers in a bit, and I think you'll be surprised, just stunned how big they are. It really is the pull the cover over the eyes scenario, and it's something that the European Central Bank knows about, and it's something that all the leaders within the Eurozone know about, and they're very, very concerned. I had said before and written that the last G20 Group of 20 meeting that we had was really about one thing. It was about trying to save the Eurozone banking system, even though, again, they had lofty goals and this and that. And the goal was to try and suck in the U.S. to provide more liquidity and fund the IMF and also fund some of the Eurozone concerns directly and put the U.S. taxpayer on the hook for this Eurozone banking system problem that has rolled out of this, that has been created because of the Eurozone system itself and the rationale behind it. So here's the dangers that are rising in a very, very big way. We're seeing, you may have noticing some ECB discord. We're finally seeing some real public squabbling going on in the ECB and the European Central Bank that we've never seen before. It's quite unusual for that to happen. What you're seeing is the German members, the German Bundesbank members that are on the European Central Bank Council, saying that the Eurozone should not be doing quantitative easing, which is, quantitative easing is a nice term for monetizing debt that was created because the industrialized countries didn't want to look like Zimbabwe, which has monetized its debt in a very big way. So we have this term quantitative easing that we've created, little political correctness. But needless to say, Germany is starting to balk over this, and one of the reasons Germany is balking over this is they don't want to be on the hook anymore for what they're already providing in terms of subsidies to the zone. Plus, they're not getting the benefits from the Eurozone that they have in the past from an export content because their export model is breaking down because of what's going on in the global economy. And Chancellor Merkel knows that Germany has its own problems, huge banking problems in Germany, rising unemployment, exports tanking. Germany needs to save as much treasury as it can for itself. So Germany is really changing its tune on the union because of the incentives are changing in a very, very big way. Plus, again, they don't want to put their own taxpayers on the hook for the incredible exposure in the pig countries have. They're starting to back away in a big way. And you may have noticed that in the press. In fact, Merkel just came out the other day criticizing all the central banks, primarily targeting the U.S. Fed and the UK. But again, it was a big shot across the bow of the ECB, supporting her own Bundesbank ECB council members. Germany sees these problems and knows how deep they are. And the reality is Germany is the only one with enough funds to step up and help solve this problem in a very, very big way. So as Germany continues to pull back from this, the risks continue to rise in the system. And you're starting to see it in the rising yield spreads are continuing. When the Eurozone and the European monetary system was first created, as I said, Portugal, Italy, Greece, and Spain, fiscal basket cases even at the time could borrow 20, 40 basis points above German interest rates, which that in itself is an artificial construct when you see that, guaranteed by the system, basically guaranteed by Germany at the time. Those spreads are now widening 200, 300, 400 basis points. I think the Portuguese yield spread over Germany at one time in the midst of the crisis ran up to 600 basis points. So that tells you that the market finally is pricing in the rising risk in this system. They know that if they had to abide by treaty, these countries right now should have already been thrown out of the system. Obviously, it's not something the European, the ECB or anybody else wants to do in the midst of this because they know the problems that could cascade once somebody decides to leave. It provides massive exposure.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.